Yeah, we've had plenty. We've invested in a company, Paperlinks, which has become Spices, and it's fallen extensively in price, and we'll never get our investment back. In fact, I think our average entry price was 50 cents, and it's about to be taken over at 7 cents. But I think the one that's destroyed the most amount of our clients' capital has been a company by the name of Arrium, which so your viewers may remember was a part a steel company, part an iron ore miner, and part a mining consumables company. And we invested a reasonable amount of our clients' money in that company. And though we sold it just before it went bankrupt, the damage had been done, and we lost about 95% of our investment. And unfortunately, it did have too much debt, and it wasn't generating cash flows, and it didn't have a competitive position in some of its businesses that made for a sustainable business. Yeah, so we get it right 60% of the time, which by definition means you get it wrong 40% of the time, and getting that win rate higher is great. It would result in massively increased performance, but you can't hit the 60% winners without being happy to strike out on some of the 40%. So it is, for a contrarian investor, just par for the course that you're going to make some big losses along the way. But equally, you do need to try and do your post-mortems and understand what it is that you got wrong on a particular thesis, and that's not worked out the way that you had intended. Oftentimes, though, it's just the way the probabilities unfold. So you might assign a 50% probability to things going particularly well, and a 50% probability to things going particularly badly. And if you probability weight those two outcomes, it might make sense to invest in something. And then the bad thing happens, and the thesis doesn't work the way you wanted it to. It doesn't mean to say that you were wrong. It just means to say that the ball fell on the wrong side of the fence. And it's important to, one, get those probabilities right, two, make sure the outcomes of each, the good and the bad scenario, you're accurate with, and three, you've got to get back up to the plate and swing the bat at the next great opportunity. From a contrarian investor's perspective, it's a graveyard for egos. It's not the type of thing that lends itself well to 40% failure rate. It's just, when you phrase it that way, it makes one shudder, and it's one of the reasons why not many people do this. In a sense, it's easy, but in another sense, and particularly emotionally, it's very, very difficult to construct a portfolio where not a single stock feels good. Overconfidence is also the kiss of death with these things. When it comes to contrarian investing, the more confident you are, the more likely you are to take outsized bets on outcomes where they may be marginal. And so we tend to be quite patient and focus on the downside. The upside generally looks after itself. It's the downside that gets you.